Our next guest made Bloomberg Business Week's list of the biggest bears, but Gary Shilling's doubts aren't confined to the U.S. He has deep concerns about what he calls a slow-motion train wreck in Japan. And you know what happened in Japan overnight? The Bank of Japan intervened to stop the yen from appreciating for the first time in 6 years. Gary, back in 2008, was correct, bang on, about all 13 of his investment guidelines, and he is with us here this morning. Gary, there were all kinds of things we wanted to talk about, including commercial real estate, China, but my goodness, we've got to talk about Japan. Japan, you've written about this for years, Japan's efforts to try and reignite an export-led economy. No matter what they do over there, it just doesn't seem to stimulate enough domestic demand. Here they've got a real problem on their hand with exports intervening to stop the yen from appreciating. Is it going to work?
Probably not to that extent, because the primary driver of exports is the economic health of your trading partner. In other words, if they're buying more of everything, it includes their imports, your exports, and that's true for any country. Currencies have a very limited impact on exports, we find, or on imports. So it's really the economic health, and that's the problem with Japan. Japan is export dependent, as you point out. They have not developed a strong domestic economy, and when you say who are they going to export to? Well, China. China's a big exporter. The U.S. economy isn't growing that well. Europe, that's slow too. So they've really got a serious problem. Doubly
damned, if you will, because exports aren't growing. There is no demand for the exports. But at the same time, with the yen appreciating to almost 82, the exports become less and less competitive. Paint us a scenario. How are things likely to evolve in Japan? Are you really that bearish on the prospects for the Japanese economy?
Well, I am long run, and this is, I say, it's a slow motion train wreck that has been developing for years. But the point is that they have been trying to stimulate the domestic economy with huge government spending, big deficits as a result, huge debts. Debts, even on a net basis, are 100% of GDP, government debts. And that was financed initially by the consumers, big savers. But now as their population ages, people are digging into their money to fund their retirement. So it depends now on saving in the business sector. But that in turn depends on exports. And as the world simply is growing more slowly and their export markets are not that robust, I think Japan has problems. And they are going to eventually start importing capital as opposed to exporting it.
Gary, as you know, the Bank of Japan can be aggressive when it comes to intervention. Last time around, they spent some 15 trillion yen. This time around, the sell side almost unanimously saying, go long yen. Based on your macro view, would you say, forget that, short the yen?
I would in a long-run sense, but it has been a safe haven. And remember, in terms of intervention, if it's your money that you're spending, you can print as much as you want. When countries are intervening to support their economy, they've got to use the other guy's currency. But when you're using your own currency, as they are in Japan now, they can do this as long as they want and as heavily as they want. After all, they just crank the printing press and sell more yen.
But are there any macroeconomic implications for the Japanese economy as a result of the printing presses rolling ever faster?
Well, they're obviously putting more yen in circulation, and they may have to worry about mopping it up. But I don't think so right
really
now.
Isn't a big problem in Japan, is it?
$12 billion in this market, that's pretty. It's kind of a token. Now maybe they're going to follow it up. They probably want to see how the markets react, and then they'll come back.